Hi guys, it's Stock Harry, and I've got an update for you on the Credit Suisse Banking Crisis and news that UBS is going to buy Credit Suisse. More importantly, I'm going to tell you what this means for U.S. stocks, especially U.S. bank stocks. So let's get into it. Credit Suisse, the risk-taking Swiss banking giant, has succumbed to the 2023 banking crisis. The bank's agreement to be bought by rival UBS marks the end of a 167-year history as an independent institution. But it's important to understand that Credit Suisse's demise was not the result of the U.S. banking crisis or U.S. regional banks going out of business. This was the result of 15 years of scandals, litigation, and strategic zigzags, while other major banks became more focused and more regulated and more free of drama. Credit Suisse has dealt with spying allegations, a $5.5 billion loss on a single client, executive turnover, fines in connection with tax and sanctions evasions, and a fraud settlement. So Credit Suisse's problems were 15 years in the making. They've just finally succumbed to all of the problems that they've been having since 2008. UBS is now set to buy Credit Suisse for $3.2 billion as regulators look to shore up the global banking system. The actual amount was 3 billion Swiss francs, which equates to 3.2 billion US dollars. The terms of the deal means Credit Suisse shareholders will receive one UBS share for every 22.48 Credit Suisse shares that they currently hold. By the way, this deal equates to about a 70% drop in value from Credit Suisse's Friday closing price. On Friday, Credit Suisse closed at around $2.01, and this deal is the equivalent of about 50 cents, depending upon where UBS actually starts trading at on Monday. The new combined UBS Credit Suisse Bank will have $5 trillion in invested assets. As part of a deal, the Swiss National Bank pledged a loan of up to 100 billion Swiss francs, or about 108 billion US dollars, to support the takeover. The Swiss government also granted a guarantee to assume losses of up to 9 billion Swiss francs from certain assets over a preset threshold in order to reduce any risks for UBS. And in classic government fashion, the Swiss finance minister said, "This is not a bailout." So it's not just the Americans doing non-bailout bailouts of banks. News of the deal was welcomed by Treasury Secretary Janet Yellen and Federal Reserve Chair Jerome Powell. Credit Suisse's scale and potential impact on the global economy is much greater than U.S. regional banks. The deal is part of an effort to prevent further erosion of confidence in the banking system. The urgency on the part of the regulators was prompted by an increasingly dire outlook at Credit Suisse. The bank faced as much as $10 billion in customer outflows per day last week. Swiss officials, along with regulators in the US, the UK, and the European Union, who all oversee parts of the bank, feared it would become insolvent this week if not dealt with, and they were concerned about crumbling confidence would spread to other banks. Now, while shareholders are getting a really good deal in all of this, bondholders are really getting screwed over. The deal will entirely wipe out around 17 billion of a special class of Credit Suisse bonds known as AT1s. These bonds were created after the last financial crisis and get written down in times of stress. Authorities said the measure was needed so that creditors share a burden along with the Swiss government, and also because of Swiss laws, there had to be a clear legal basis for the write-off. AT1 stands for Additional Tier 1 Bonds, and the AT1 bonds will be completely written down. The bonds will be written off to a value of 0. These additional Tier 1 bonds, also known as contingent convertible bonds or COCOs, were introduced after the financial crisis as a way to transfer banking risk away from Swiss taxpayers and onto bondholders. They are complex financial instruments that were designed to be converted to equity or written down if trouble at an institution emerges. They've grown in popularity with European banks and investors in recent years because of the extra yield that they tend to offer. Last week, growing problems at Credit Suisse prompted a plunge in the bank's AT1 bonds, and Credit Suisse has counted major institutional investors as holders of these bonds. So who are these institutional investors who hold these AT1 bonds that are now worthless? Well, we don't know, but we're more than likely going to find out this week, meaning we might see some more downward pressure on bank stocks this week once it becomes a little bit more clear who is actually holding these AT1 bonds that Credit Suisse had. And while all of this was happening at Credit Suisse, mid-size U.S. banks were reportedly asking the FDIC to insure all deposits for 2 years. A coalition of mid-size U.S. banks, known as the Mid-Size Bank Coalition of America, or MBCA, had sent a letter to regulators. That letter argued that extending insurance will immediately stop the exodus of deposits from smaller banks, which in turn will stabilize the banking sector and restore confidence in the banking system. U.S. lawmakers are now examining the merits of a higher FDIC bank deposit insurance cap. When asked what the new higher levels should be, Senator Warren, who's a member of the Senate Banking Committee, said that is a question that we have to work through. Is it 2 million? Is it 5 million? Is it 10 million? Regional banks are asking for an unlimited amount for the next 2 years, but senators are looking to only increase it possibly to somewhere between $2 and $10 million. The fact is, even if the FDIC insurance is increased or even made unlimited for the next 2 years, it's going to take a couple of months for consumers to recognize that all of these banks are stable. Pressure on mid-sized and smaller banks from deposit outflows continued on Friday, despite a move by several large banks to deposit $30 billion into First Republic Bank. Regulators may need to repeat a temporary blanket guarantee on all U.S. deposits. Now, under the Dodd-Frank financial reform law, such a move would require Congress to pass a resolution of approval on an expedited schedule. So be on the lookout this week for news from Congress on what they're going to do about this FDIC insurance. Meanwhile, the FDIC is set to relaunch their sale of Silicon Valley Bank in a plan to break up the bank and sell off smaller portions of it rather than the entire bank all at once. Now, even though bank stocks whipsawed last week, bank profit estimates barely budged. And that's why, despite the market volatility, retail investors went on a buy the dip spree. Last week, despite financials dropping over 8%, almost $1 billion of retail investments went into buying financials last week. Charles Schwab, ticker SCHW, saw the second most inflows, following Bank of America, ticker BAC, over the past week. Some adventurers, including myself, were buying First Republic Bank, ticker FRC, PacWest Bancorp, ticker PACW, and Truist Financials, ticker TFC. Those are described as riskier bets that could potentially offer massive upside if systemic risk can be held at bay. The fact is, people are starting to wonder if bank stocks are bargains right now. What I'm about to show you is a list of U.S. banks and bank holding companies that have had the highest average returns on assets, known as ROAA, over the past 15 years. And this might be useful for you if you are looking for bargains following the 25% decline for the KBW Nasdaq Bank Index, ticker BKX, for 1 week through Monday. At the same time, the financial sector of the S&P 500 fell 12% last week. Those stocks with outsized returns that might be extremely undervalued at this point include American Express, ticker AXP, Discover Financial Services, ticker DFS, Bank OZK, ticker OZK, Raymond James Financial, ticker RJF, Stifel Financial, ticker SF, Home Bank Shares, ticker HOMB, Prosperity Bank Shares, ticker PB, U.S. Bank Corp, ticker USB, Commerce Bank Shares, ticker CBSH, and Capital One Financial, ticker COF. So what is it going to take to calm the banking sector jitters? Well, the answer is time and a Fed rate hike. Keep in mind that we're only a week into this. It's going to take time for fear to leave the market. The important question for this week is, what does the Fed do if they don't hike rates? What is the message that they send? If they don't hike rates, that basically means panic mode, and investors are going to be running out of what they deem to be a burning building. Why is that? Because if the Fed pauses, that means that they feel like there is a major problem in the U.S. banking sector, so much so that it requires them to stop fighting inflation in order to save the banks. And all that's going to do is add more fear to the markets and cause quite possibly an even larger bank run and a larger sell-off of U.S. stocks. So the best course of action for the Fed is to raise interest rates by at least 25 basis points to come out, remain hawkish, and say, we're not worried about the banks. All the banks are fine. They're safe. They're secure. They're not going anywhere. We are going to continue our fight on inflation. That is the best message that the Fed can deliver this week, and that's why they have to do a 25 basis point rate hike. Luckily, the Fed is poised to do a quarter-point rate hike this week, despite the market turmoil. CME futures are pricing in a 62% chance of a 25 basis point rate hike and a 38% chance of the Fed pausing. By the way, this is expected to increase more into the 25 basis point rate hike portion of the Fed futures since we made it through the weekend without any more major bank problems. So here's what's at stake for your stocks and bonds as the Federal Reserve weighs the bank chaos against the inflation fight. Well, be careful this week because markets are going to be in a vulnerable position ahead of the Federal Reserve's meeting. Traders are betting that the banking crisis could lead to meaningful interest rate cuts over the next 12 months. But the Fed's emergency measures help to stabilize the financial system, which should give it room to go and fight the inflation that remains too high in the economy. Economic expansion in the U.S. and inflationary pressures tied to wage growth don't align with traders' expectations for rate cuts over the next 12 months, and that leaves the markets at risk. The problem is that you could easily get tighter monetary policy being priced in, which would hurt both stocks and bonds. The Fed is meeting this week on Tuesday and Wednesday, and at 2 p.m. Eastern Time, about 2 hours before the market closes on Wednesday, the Federal Reserve will release its interest rate decision, and then about 30 minutes after that, Fed Chair Jerome Powell will hold a press conference and answer questions. Now, don't forget that this FOMC meeting is a special one because it also includes an updated SEP, or Summary of Economic Projections. And this is really, really important because since the banking crisis has come out, there's a lot of uncertainty around how much the Fed plans to raise interest rates for the rest of the year, when they possibly expect to start cutting rates. Nobody knows. There's a lot of uncertainty. So it's really going to be that summary of economic projections that will be released at 2 p.m. Eastern Time on Wednesday that will really show us what the Fed actually plans to do and whether or not they actually plan to start cutting rates or not. If the SEP shows that the Fed has no plans to cut rates over the next 12 months, that could cause the stock market to crash on Wednesday and Thursday of this week. So it is one of the things that we're going to have to watch out for, and it's a major concern that could absolutely cause the market to go down. Right now, the market is still extremely fearful over the banking crisis. That's caused a little bit of downward pressure. But overall, the market's still fairly bullish and still looking at the Fed to cut rates. So anything that shocks the market and shows that's not the case, it could be disastrous for the stock market. So be careful this week because we don't really know what's going to happen. But one thing we do know is that it will be a very volatile week with major swings both up and down in stocks. And if you want to know everything that you need to watch out for this week, including a review of the technicals as well as the market sentiment and the other news that I didn't have time to include in this video, make sure you sign up for my free newsletter. That newsletter goes out every Monday morning. You can sign up for that free newsletter at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video with your friends and family and on your social media pages so that they will know what's going on in the markets as well. And don't forget to hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. And if you missed the buys that I made on Friday, I made a video that shows you everything that I bought on Friday. Make sure you watch that last video that I uploaded here.